الحمد لله رب العالمين ثم الصلاة والسلام على رسول الله وعلى آله وصحبه ومن والاه. We give thanks to Allah subhanahu wa ta'ala, the Lord of the great throne. We praise Him, we seek His help and His forgiveness. Alhamdulillah. So over the last couple of weeks, I've actually received quite a number of requests from friends and associates who wanted me to comment on the specific changes that we have through the Nigerian tax reforms, and especially how that impacts individuals and as well as enterprises and small companies, as the case may be. So that's why I've decided to host this particular session. I intend to keep this quite straightforward for about an hour, just to discuss the changes that we have brought by the new tax laws that has now been signed into law by the President and Commander-in-Chief of the Armed Forces of the Federal Republic. So in the next couple of minutes, so that's what I will be speaking to. So generally, I will give a general overview of the tax reforms, what exactly informed the decision of government to institute these sweeping changes to our tax laws. I will also do a bit of a deep dive into the changes that impact individuals and enterprises. I will speak about small companies and the changes that will impact their businesses, and also some of the changes under the administration of taxes. So what are the key changes that have been brought in place with respect to how taxpayers engage with tax authorities as we move into the implementation phase of the new law. And then I'm going to give some pieces of advice to small businesses and to individuals on how to mitigate the negative impact, if there is, of the new laws on themselves or their businesses, and also to suggest some tax optimization options that they can explore. So that exactly will be what I'll be speaking to. So starting off will be what is the trigger for the changes in the tax law. So this time around, we have over the last 1 year and a half, the President constituted a committee led by Mr. Taiwo Oyedele, and the main mandate on that particular committee is to carry out a comprehensive overhaul of our tax system. For those who are conversant with the changes we have experienced within our fiscal space in the last 5 years or thereabout, you will recall that during the last administration, the administration of the former President Muhammadu Buhari, we had a yearly ritual of the Finance Act, which were signed into law alongside the budget. So that sought to make some changes or amendments to our tax laws, specifically areas that we've had clamors from taxpayers. So these were changes that were made in order to lighten the burden on companies, as the case may be. But that also brought about some other unintended issues, and chief amongst that being that the fact that the laws were being changed on a yearly basis, it created a situation of uncertainty. So businesses that actually plan for long-term options, so they have issues and regarding what changes will be brought into the law maybe for the next year. So they were not so certain about the impact of these changes or the ramifications these changes will bring into their business. So this time around, the President has constituted a committee, and the committee worked for about a year, drafting new set of laws, and this was submitted to the National Assembly for deliberation, and subsequent to legislative passage of the law has now been signed by the President. So this was signed on the 26th of June of this year. So I will speak to the trusts for these changes. Prior to now, we've always talked about the issue of the low tax to GDP ratio of the country. So Nigeria currently hovers around 12%. For a number of the other countries in sub-Saharan Africa, the average is around 18%. For member states of the OECD, the average is between 35 and 40%. So you just want to imagine how lowly Nigeria is playing when it comes to income that is generated from taxation. So this law also seeks to plug all of those loopholes and also look for avenues to ramp up income that is generated from taxes. We've had this issue of multiplicity of taxes, and this is something that does not only pertain to individuals, it impacts businesses. You have the Federal Inland Revenue Service and the other state internal revenue service, and sometimes even non-state actors collecting one type of levy or the other. So it's been a huge problem within the tax landscape in Nigeria. So one of the key objectives of this particular new set of laws is to cut down on the number of taxes that individuals and also companies will be required to pay, and also to take out or eliminate entirely nuisance taxes that oftentimes are being collected by non-state actors that eventually will not end up in the coffers of government. And one other key important thrust for this new law is to ensure that our tax laws are progressive, to ensure that low-income earners don't have to suffer the burden of paying taxes, and those who are the high-income earners will pay relatively more than what they are currently paying. So one of the other key thrusts of the new law is to mobilize tax revenue with digitization for efficiency. We want to digitize our tax process. So all of these issues of using archaic approaches to collection of taxes, there are better ways to do this, and these have been done in other climes, and the tax laws have now been written to take into cognizance the opportunities for us to digitize. We have seen quite a number of digitization, especially among some of the taxing authorities. But since that now is being driven by the legislation itself, so we expect that it's going to be all-encompassing. So one very important objective of the law also is to simplify our tax law. So those who are conversant with taxation, we understand that from the major canons of taxation is simplicity. Taxpayers should be able to go through the tax law and understand what exactly they are required to pay, what taxes are they required to pay, and to which particular taxing authority. For all of us who realize that in Nigeria we have 38 different taxing authorities. We have the Federal Inland Revenue Service, and each of the states have their autonomous independent revenue services. So that is not maybe what happens in other climes. So for instance, in the UK, in Ghana, in South Africa, in Kenya, they have just one single tax authority that collects taxes or all types of taxes from both corporates and individuals. In Nigeria, it's a bit different. So for subnationals, they are responsible for collection of personal income tax from individuals that are resident within their jurisdiction. And FRS, as the case is, collects corporate taxes, VAT, and a number of other levies on behalf of the government. And one other very key important need for the review of our tax law is for us to standardize tax administration process in order to lower the cost of tax collection. It has really been a big issue that, especially for the nuisance taxes, that the cost of collection can be as high as 80% of the collection. Then you just want to imagine what then is the need for collecting such taxes if 80% of the revenue that is generated is deployed to the costs for collecting the taxes. So moving on to the key changes, like I mentioned earlier, we are having a comprehensive change to our tax law. Currently, we have different bodies of law that govern taxation. We have the Companies Income Tax Act, we have the Personal Income Tax Act, we have the Value Added Tax Act, we have the Stamp Duties Act. We have quite a number of different bodies of law that guide different tax types. So what we're doing now is to streamline all of this, and going forward we are going to have just 4 bodies of law. The first being the Nigeria Tax Act, the second the Nigerian Tax Administration Act, the third the Joint Revenue Board Act, and the fourth the Nigerian Revenue Service Act. So with respect to the Nigerian Tax Act, so that is the law or the body of law that governs what type of taxes are to be collected. So if you are looking for where to find the type of taxes that will be collected from individuals, from corporates, then you find that under the Nigerian Tax Administration, the Nigerian Tax Act, the NTA. So that piece of legislation aims to provide unified fiscal legislation governing taxation. So it repealed about 12 different principal tax legislations and amended some other 15 subsidiary legislations. So that's with respect to the NTA. The second is the Nigeria Tax Administration Act, and just like the name connotes, so it's the piece of law that governs how taxes are to be administered. Collection of taxes, what tax authority is to collect what type of taxes. You find all of that under the Nigeria Tax Administration Act. What are the filing obligations, the timelines for you to file, and the penalties for breaching any of the tax rules. You find all of that documented under the Nigerian Tax Administration Act. So for taxpayers, these two bodies of law are the most important, and they are going to take effect from the 1st of January of next year, 2026. So the first two. So with respect to the other two, they are already in force. The first being the Joint Revenue Board Act. So what that piece of law tries to do is to reconstitute what we used to have as the Joint Tax Board. So now it's being referred to as the Joint Revenue Board. So it's like a melting pot for all the different taxing authorities to engage. And also, when there are disputes, they use that avenue to engage and also seek means of resolving dispute among the different tax authorities. They also use it as a platform to renew and harmonize policy implementation process. Under the Joint Revenue Board Act, we have the introduction of the reconstituted Tax Appeal Tribunal. So for those for instances where you have litigation or differences between taxpayers and tax authorities, if they want to go through the appeal process, so they have to go through the Tax Appeal Tribunal before going to any one of the courts. So we have a new introduction, and that is the introduction of the Tax Ombud. So that's something that is new to our tax law, and the Tax Ombud will serve as an independent arbiter in order to facilitate tax dispute resolution between taxpayers and tax authorities. Like I said, that's a new introduction to our tax law. The fourth body of law is the Nigeria Revenue Service Establishment Act, which reconstitutes what we now have as the Nigeria Revenue Service that is going to replace what we currently, or what we have always been used to, and that's the Federal Inland Revenue Service. So we are now going to have a brand new revenue service that will be responsible not just for collection of taxes, but for the collection of other revenue on behalf of the Federation. So they will be supporting a number of the agencies that are currently revenue generating in the process of collection of those revenue on behalf of the federal government and the Federation, as the case may be. So that gives a general overview. And for those, for the drafters of the law, they add certain principles or a design philosophy for them to come up with the different laws that we currently or we will now going to be implementing going forward. And three of those guiding principles. The first is that they made it a base principle that they are not going to tax poverty. We are no longer going to tax capital, and we are not going to tax investment. So those very important principles actually underline all of the laws that were written. So the laws were written to attend to all of those. For instance, under the current regime, you have companies that make losses that are required to pay minimum tax. So if you pay minimum tax and you are making a loss, the implication is that you are paying the tax on your capital. So it really doesn't make any sense that a company that is loss making is still required by law to be paying taxes to government. And the same also applies to individuals. So the committee actually deliberated on agreeing on the baseline for poverty. So what's the poverty line? Such that anybody that falls below that line should not have to be burdened with the responsibility of paying taxes. So these were very critical guidelines that the committee actually worked by in coming up with the new tax law. So now moving on to the key changes. Like I mentioned, I'm going to speak to changes that impact individuals and enterprises and also small businesses. So first with individuals and enterprises. The very first change is actually on the basis of taxation itself. So we are having a clear-cut indication under the new law as to what is the trigger for an individual to pay taxes in Nigeria. Under the current law, which is the Personal Income Tax Act, it's not written in black and white. So you have to infer when you read different sections of the law to infer that, okay, it seems that the basis of taxation is because you are resident in Nigeria. But now it's quite clear. An individual is liable to paying taxes in Nigeria because you are resident. And the triggers of residency are clearly stated. So from the triggers of residency is that the individual is domiciled in Nigeria. If you are domiciled in Nigeria, then if you have income that is liable to tax, you will have to report that to the relevant tax authority and pay taxes. If you have a permanent place available for your domestic use in Nigeria, that also is one of the triggers for residency, and by implication for which will mandate you to pay taxes in Nigeria. If you have a place of habitual abode in Nigeria, then that also is from the triggers of residency. If you have substantial economic or family ties to Nigeria, that also is a major trigger for residency in Nigeria. And if you sojourn in the country for 183 days or more within a 12-month calendar period, so that can span over 2 years or can be within the same fiscal year. So the implication of this is that if you meet any one of the criteria that I've mentioned and you have income liable to tax, then you have to pay income in Nigeria on your worldwide income. So you are not just paying taxes with respect to your income that is sourced from Nigeria. So you are liable to tax on your worldwide income. So if that is triggered. So if you now drill this down to employment income, for those in employment, the triggers are two. The first is if you are an employee that is resident in Nigeria. That's the first. And I've already spoken to the triggers for residency. The second case would be for an individual that is non-resident, but the duties of his employment are carried out partly or wholly in Nigeria. So it's non-resident. All of the triggers I've mentioned before, it doesn't fulfill any one of those conditions. But the duties of his employment are carried out here in Nigeria, either partly or wholly. So that in itself will drag the person under the Nigerian tax radar. But if the person is paying tax in his home country on that income, he will not have to pay taxes in Nigeria. So that's how the law has now been written. So there's something striking about the way the law is now as against what we have under PITA. Under the Personal Income Tax Act, the trigger for employment income is actually more pronounced or it's related to the status of the employer as against the status of the employee. So PITA will say that the income from an employment is deemed to be derived from Nigeria if you have a Nigerian employer. Meaning that if your employer is in the country, irrespective of where the duties of employment are carried out, you'll be liable to pay taxes if you have a Nigerian employer. But in this case, we are not concerned about the status of your employer. What the law is concerned about now is your own status. So if you are an employee and you are resident in Nigeria, you are liable to pay taxes here, even if your employer is a non-resident company. If your employer is based outside of the country, you will still be required to pay taxes if you are domiciled or you trigger any one of the conditions for residency in Nigeria. So by implication, for companies that have expatriates, they need to review their assignment, the mobility assignment contracts, because what this law seeks to do is to expand the tax net. And by implication, if an expatriate fulfills the conditions for residency, he is going to be liable to tax not just on his employment income, but on his worldwide income. If he has investment outside of the country, he will have to report that to the relevant tax authority in Nigeria for the purpose of taxation. So I will speak quickly to the taxable income. What are those income that as an individual that is tax resident in Nigeria that you are liable to be charged taxes on? The first will be profit or gains from a business or trade that you carry on. For those who are in employment, the salaries, your wages, all of your perquisites of employment are liable to tax in Nigeria, except for specific items that have been exempted under the law. We'll still speak to some of those specific items that are exempted as we move on through this discussion. So you have royalties, dividend, all of these are considered to be income that is chargeable to tax in Nigeria. There are a few new introductions. First being prizes, winnings, honoraria, grants, awards, and laurels. These have now been clearly stated to be chargeable to tax in Nigeria. For instance, we've had this gray area around maybe winnings. We've had cases where maybe someone goes for a reality TV show or some TV shows or such kind of reality shows that it gets to win certain prizes, and the tax authority will want to charge that to tax. And some individuals will have the view that that is not clearly stated under the Personal Income Tax Act to be liable to tax. But now all of those gray areas have been laid to rest. If you have such kind of income, then it's now liable to tax. If you go for speaking engagement and you are paid honorarium, you need to report that for tax purpose. Another of the new introductions is profit or gains from transactions in digital assets. So for those who deal in maybe cryptocurrencies and digital transactions, if you have gains from such transactions, you'll be required to report that for tax purpose. With respect to the exempt income, there are a few income items that have been classified to be exempt. First, returns from investment in federal and state government bonds. So for those who invest in federal or state government bonds, then that returns is now fully exempt. Federal government bonds or investment in federal government bonds have always been exempt, but state government bonds have now been included under the exempt heading. So the implication is, for instance, for those who have investment in sukuk, whether it's federal government sukuk or state government sukuk, if you have returns on such investments, that income is fully exempt from tax. If you have drawings from your retirement savings accounts, that has always been exempt. For those who are retired and they are drawing from their pension retirement savings account, then that indeed is fully exempt from tax. So now, wages and salaries of military officers are now fully exempt. So for those who are members of the Nigerian Army, Nigerian Navy, Nigerian Air Force, Nigerian Police, especially those who are not in civilian capacity, then all of their salaries are now exempt from tax. So any sum that is paid as gratuity is now fully exempt. So we've had this gray area when it comes to gratuity. Under the Personal Income Tax Act, there are some readings that give some threshold for which you can get exemption, even though there had been a number of legal precedents from the courts that exempted gratuity. But now it is clearly stated, gratuity payment to exiting staff is now fully exempt from tax. So individuals that earn the national minimum wage or less are exempt from tax. So we had that introduced by one of the finance acts during the last administration. So that also has been instated under the new law. So if you have people working for you and you are paying them the national minimum wage or less, then you don't have to make any withholdings from them. Their income is fully exempt from tax. Currently, the national minimum wage is 70,000 naira every month. So any individual that earns 70,000 naira or less in a month, such income is fully exempt from tax. So with respect to benefit in kind, for those who are in employment, if you have certain benefits that are not monetary, that you gain from such employment, the way that is subject to tax or valued for taxation for a few of the items have been adjusted a bit. For instance, if your employer has an asset in its name and that asset has been made available for your exclusive use, so you are deemed to have received benefit equal to 5% of the acquisition cost of that asset. That will be what will be liable to tax in your hands for each year that the asset remains in your custody. For instance, the company has a vehicle that was procured in the name of the company and has been assigned to you as your official vehicle. So the official vehicle that is given to you as your status car, 5% of the acquisition cost of that vehicle will be liable to tax in your hands, for each year that the asset remains in your custody. So that law is what we currently operate, and that is exactly what has been replicated under the NTA, the new law. So it's not changing. But if that asset were to be leased or rented from a third party, the entire cost incurred by the company in making that asset available to you will be what will be liable to tax in your hands. That exactly is the current provision. That is what has been replicated under the new law. But what is changing is actually with respect to how we value living accommodation. The company has a property, like an apartment, and that apartment has been assigned for your exclusive use. So under the current law, what happens is that the tax authority will come to such a property to do some valuation. So they will give maybe a rental value to that property. Okay, this property in this particular area, what will have been the costs or the expense that will have been incurred by the company if it was procured from a third party. So that is what we currently do. So the tax authority will do a valuation, and the amount or the value that has been put on that property, I mean the rental value, will be what is liable to tax in the hands of the beneficiary. That is the employee that is benefiting from that benefit. But now what the law is saying is that there is going to be a cap. So it's not the entire amount now that is going to be liable to tax in your hands, especially if the rental value is more than 20% of the individual's gross income. We are going to peg it to the individuals, to 20% of the individual's gross income less that rental value. So that's what is changing. And we also have the expansion of the list of benefits in kind that are fully exempt to include all work tools. So if something is considered to be a work tool, it is now fully exempt from tax. So if you are employed by a company that provides non-assignable lunch vouchers to employees to go to a designated canteen for them to take meals, that has always been exempt from tax, and that also is the current provision. It is fully exempt from tax. Okay, so moving on to eligible deductions. What are those deductions that as an individual or as an employee, if you incur such deductions, you will be able to reduce your tax liability by whatever it is you are paying off in deductions. With respect to these deductions, the first is any contribution you make to the National Health Insurance Scheme. For most companies, they procure the services of health maintenance organizations, HMOs, for their staff. Maybe they put staff on a particular plan. So if as a staff you decide to upgrade to a higher plan, maybe they put you on silver and you want to upgrade to platinum, and you have to pay out of pocket. So whatever payment you are making out of pocket serves as a relief for you. So you should provide that information to HR or to the responsible party within your company. They will be able to incorporate that in the tax computation and reduce your tax liability thereby. That also applies to contribution to the contributory pension scheme. Whether it's your statutory contribution or your voluntary contribution to the scheme, it serves as a tax relief for you. If you have a mortgage and you pay interest on such mortgages, that also is exempt from tax, or by implication, you can reduce your tax burden by whatever interest you suffer on such payment. Annuity payment or life insurance payment or premiums that is paid in order to insure your life or that of your spouse, that also is considered a relief for tax purpose, and that is enjoyed on a preceding year basis. The premium you pay in a previous year, you enjoy it in the current year. If you make contributions to the National Housing Fund through the Federal Mortgage Bank, whatever contribution you are making to that scheme also is deductible. You relieve your tax payment by that. So for those who are engaged in businesses, you have a side hustle, you have a small enterprise that you are running. Every cost that you incur in order to generate the profits of that business is deductible. Insofar it fulfills two conditions. It is wholly and exclusively incurred for the purpose of generating the profits of that business. So that is a good one. Prior to now, we had 4 conditions that had to be fulfilled for you to enjoy deductibility of your expenses. So we normally call it the rent test. They will say the expenses have to be wholly, reasonably, exclusively, and necessarily incurred for the purpose of generating the profits of that business. So the need for you to demonstrate reasonability and necessity is no longer required. So you only need to demonstrate that the expense that you have incurred in your business is or have been wholly and exclusively incurred for the purpose of generating the profit of that business. So there is a relief that we currently enjoy as individuals, which is called the Consolidated Relief Allowance. We call it the Almighty CRA. So that relief has been removed from the tax law. So we are no longer going to be enjoying that relief going forward. By implication, the relief for individuals that currently earn above 20 million naira, because of CRA that they enjoy, 21% of their income, they enjoy tax-free. For those who earn lower than 20 million, they enjoy at least 20% of their income tax-free. That particular relief has been removed, and we have the introduction of another type of relief, which is called the rent relief. And just like the name implies, it's only applicable to individuals that pay rent. So if you are paying rent to your landlord in any particular year, so you are eligible to claim as much as 20% of your annual rent paid, but it is capped to 500,000. So the implication of that is that if you are paying rent in excess of 2.5 million naira in a year, you cannot claim more than 500,000 in rent relief in that particular year. So, but you will be required to provide some documentary evidence that substantiates that you have actually incurred that particular expense. So maybe your rental agreement with your landlord, or the receipt that is issued by the landlord to you when you make such payment. You need to provide that for you to be able to enjoy that particular relief. So I will speak to some other key changes. The single most important change for individuals and enterprises is the change to our tax rates and our tax law, tax bands. Tax rate and tax bands. So that's changing. Under the current regime, we actually operate a graduated scale of tax scale for individuals in Nigeria. Currently, it spans from between 7% and 24%. So that is changing. So we are not going. The rates are now going to modulate between 0% and 25%. And the intention of the drafters of the law is to ensure that low-income earners don't pay taxes at all. Because we have had quite a number of rumors going all over the place that, yeah, you are not going to be taxed more and all of those things. Actually, the intent of the drafters of the law, and if you do a simulation of what the law is saying, it comes to the fact that low-income earners will not have to pay taxes. Middle-income earners, some of them might pay slightly lower than what they are currently paying, and some of them might pay slightly higher or marginally higher than what they are currently paying. But for high-income earners, they will pay significantly more than what they are currently paying. So I will speak to all of this. So like I mentioned, the current tax rate modulates between 7% and 24%. By implication, if you do the effective tax rate, you will see that for individuals that earn above 20 million naira, currently, they don't pay more than 18.96% of their income in tax. The maximum tax rate that anybody that pays or that receives more than 20 million naira in a year currently is 18.96%. You can't pay more than that. For individuals that earn less than 20 million naira currently, the maximum effective tax rate is 19.2%. You don't pay more than that. So there's currently nobody in the country that pays more than 19.2% of his income as an individual in taxes. So that's the maximum. But if you modulate it or go into the new tax law and the way the tax table has been structured, you will see that for low-income earners, they don't have to pay taxes. Just like I've mentioned, the first 800,000 of your chargeable income in a year is to be taxed at 0%. Everybody enjoys that. The first 800,000 of your chargeable income being your gross income, which is your aggregate income for the year, less all of your eligible deductions. You have taken out your pension, you have taken out your NHF, or all of the other deductions that you are eligible to take in via payroll. When you take that out, you are left with your chargeable income. Then the first 800,000 in a year of that chargeable income is assessed to tax at 0%. Everybody enjoys that. So what you are losing out on the CRA that has been repealed, you take advantage of that with the way the tax rate have now been structured. But as you move higher the tax band, then individuals will have to pay maybe slightly lower than what they are currently paying, or slightly higher, depending on where you find yourself. We'll still speak to a bit of the simulation that we've done so that we bring this closer to us. But for high income earners, they will expect to pay significantly higher because, like I mentioned, currently the maximum effective tax rate for anybody that is earning above 20 million naira is 18.96%. And that is going to now shift close to 25%. So you can see someone moving from 18.96% to 25%. So that's something that's quite substantial. And that will be for high income earners. So with respect to compensation for loss of office, for individuals perhaps that their employment has been terminated by the company, it has to be an action triggered by the company. The company terminates the employment of an individual and consequently pays the individual some form of compensation. Currently, it is a capital gains related transaction and is currently documented under the Capital Gains Tax Act. So if an individual is paid such kind of compensation, any compensation that is paid to him up to 10 million naira currently is exempt from tax. Any payment in excess of 10 million naira is chargeable to tax at 10%. But what the law has now done is to significantly increase the exemption threshold. So it's moving from 10 million to 50 million. So by implication, anyone whose employment has been terminated and the company decides to pay compensation, Any compensation that is paid to that individual up to 50 million is exempt from tax. No taxes will be deducted. Any payment in excess of 50 million will be chargeable to tax at the prevailing income tax rate. So it's no longer going to be at 10%. So we're going to include that additional payment in excess of 50 million alongside. We add it to your other chargeable income in the year and subject it to tax, as the case may be. So if you have gains on disposal of principal private residences, so for someone that wants to dispose of his house, his property where he resides, so you are allowed to make a disposal of one property, tax exempt, it's fully exempt, but you only enjoy that once in a lifetime. So maybe someone has a house, a personal house, and he disposes it off. So if you dispose of a house, your personal house, you will not be charged with tax on that if it's just one building. So that is one per lifetime. But in case maybe subsequently you want to dispose of any other property, any gains from such disposal, you will need to account for tax on that. Personal chattels, meaning your tangible, movable properties, if you dispose them of, then that is exempt from tax insofar the consideration is not or does not exceed 5 million or 3 times the annual national minimum wage. If you dispose any movable personal property, apart from vehicle, as the case may be, any tangible, movable property, then it is exempt if the consideration does not exceed 5 million or 3 times the annual national minimum wage. For motor vehicles that are used for personal use, they are engaged in personal use or for not-for-profit purposes. If you dispose it off, it is exempt from tax if it's not more than 2 vehicles in a year. Not more than 2 vehicles. So I'm not talking of individuals that deal in the sale of vehicles. You have your personal car that you want to dispose of. So a maximum of 2 in a year, you have tax exemption. So you are not going to be subject to tax on any gains on such transactions. Like I mentioned earlier, every taxable individual in Nigeria now is liable to tax on his worldwide income. But Nigeria allows for unilateral relief on double taxation. So if you have income from outside of the country that has suffered taxes, so there's a way for you to claim credit on against the taxes that you have suffered outside of the country, and that is just to mitigate the effect of double taxation. So with respect to enterprises, because an enterprise or someone that is operating as a business name, your business is no different from you. So there's no difference between an individual that owns an enterprise and the enterprise itself. So the applicable tax rate is exactly the one for individuals, just like we've mentioned previously. So the point now will be that if you have a business you are running, you need to have documentation in place in order to be able to record all of your business expenses. Just like I've mentioned previously, you are only required now to demonstrate that all of your business expenses have been incurred wholly and exclusively to generate the profits from that business. So the way it's done is that when you aggregate all of your revenue, you have your cost of sales, which are the costs you incur in manufacturing or in putting the goods, making the goods available to be resold, as the case may be. You have all of those expenses that you incur, maybe your personnel costs and all of those to get your profit. There are a number of other deductions that you can take advantage of, like your capital allowance on your assets. For individuals that maybe have assets that they deploy in their business, someone has a car that you are using to distribute or to do all of those things. All of those assets you can incur, or you can actually take advantage of the capital allowances on those assets in order to reduce your tax liability. So once you have aggregated all of those and you have taken all of your eligible deductions, then you pass it through the normal tax table. So that's what is expected. But you also need to reevaluate your business model. Because of the advantages now that the new law has given to small companies, it might make more sense now, especially if your revenue as a business is still not up to 50 million naira in a year. It might be better for you to operate as a limited liability company so that you take advantage of the exemption for small companies than for you to run as a business enterprise. Because as an enterprise, your business is not different from you. So if you make profit, if you have taken out the eligible deduction, whatever is left will be subject to tax the same way that all of your other income will be subject to tax. But if you are operating as a small company, just like we have mentioned, small companies are exempt from tax, corporate tax, capital gains tax, and the development levy. So you might need to reevaluate your business portfolio, especially, just like I have said, if your business revenue is not more than 50 million naira and your fixed asset is not more than 250 million naira in any year, you might need to reevaluate whether you want to continue to operate as a business name or you intend to operate as a limited liability company. There are a whole lot of advantages for small companies or enterprises that maybe their revenue is still less than 50 million, so rather operate as a small company, a limited liability company, than to continue to operate as a business enterprise. Just to add that, so that indeed is a very important point for business owners, especially small business owners. So moving on to the simulation that we've prepared just to bring this closer to our understanding. So I have put up a simulation here to compare different income levels, the tax that is payable under the current tax law, and what the tax will come up to if it's simulated under the new tax law. So I've done these for a number of different income levels, and the comparison here is just between the CRA that is currently being enjoyed under the new tax regime as against the tax relief that is allowed under the one that will take effect from next year. So you will see here, for an individual that earns annual gross income of 5 million naira. In a year, the person earns 5 million naira. Currently, under the Personal Income Tax Act, the person pays something in the region of 704,000 naira in taxes. So that's about 14.08% of his income paid in taxes. If you simulate the same income on the new tax law that will take effect from next year, you will see that the taxes for that individual drops from 704,000 to 636,000. So that's about 68,000 naira in tax savings. The effective tax rate for that individual drops from 14.08% to 12.72%. So you can see that individuals within that bracket will be paying relatively lower than what they are currently paying under the Personal Income Tax Act. The same applies to an individual that earns annual gross income of 15 million. We see with this, under the current tax legislation, the person will pay about 2,624,000 naira in taxes. That's roughly 17.49% of his income paid in taxes. If that same income is simulated under the new tax law, the taxes drops by 149,000. So it's now going to be paying about 2,475,000 naira in taxes. So that culminates to about 16.5% as its effective tax rate. So it's paying 16.5% of his income in tax. But when you start moving close to the 25 million mark, that's when you start seeing some marginal increase in tax payment. The simulation I've projected here doesn't have the 25 million, but for someone that earns 25 million, if you simulate it under the current law and compare that to the simulation done under the new law, you will see about maybe 40,000 naira additional tax payment in a year. So that's when you start seeing some marginal increases in tax payment when you compare the new tax law as against the current tax law. So for an individual that earns 30 million naira, you will see that tax payable on that income under the current tax law is around 5,480,000. So that is about 18.27% maximum effective tax rate. If you simulate the same amount of 30 million naira under the new law, you will see that the tax payable on that income increases marginally. So to about 5,715,000. So that's about 235,000 naira in additional tax payment in a year. So the effective tax rate for that individual moves up to around 19.05%. So for an individual that earns about 90 million naira in a year, under the current tax regime, the person pays about 18.73% of his income in taxes. So the tax payable on that income currently is about 16,850,856,000 naira in a year. So if you simulate that under the new tax law, you will see that that increases significantly to about 20,305,000. So the effective tax rate moves from 18.73% to about 22.56%. Additional tax payable on that income is about 3.5 million in a year. So if you are any more than 70 million naira in a year, under the current tax regime, you pay about 18.84% of your income in taxes. That's about 32 million naira. If you simulate that same income under the new tax law, you will see that your tax bill is going to increase by roughly 8 million naira. So that will move the ETR to around 23.71%. For an individual that earns 245 million naira in a year, you will see that your effective tax rate is about 18.88% under the current tax regime. So you pay about 46 million naira in tax. But if you simulate that same amount, 245 million naira, on the new tax, under the new tax regime, you will see that your effective tax rate moves from 18% to 24%. So the person will have additional tax liability of about 12 million naira to pay, or about 13 million naira to pay in under the new tax regime. And the last simulation we've done here is for someone that earns about 365 million naira in a year. So you will see that under the current tax regime, you pay about 68.9 million naira in tax. That's roughly 18.90% of your income in tax. If you simulate that same amount under the new tax law, you will see that the tax bill increases significantly. Additional tax payment of 20 million naira on that individual in a year. So your effective tax rate moves up to about 24.4%. And just like I said earlier, the intent of the drafters of the law is what we can see in effect with this simulation. Low income earners will not have to pay taxes. For middle income earners, some of them will pay marginally lower than what they are currently paying, and some of them might pay marginally higher than what they are currently paying. And for those who are high income earners, they should expect significant move in their tax payment from about 18% to 25%, as the case may be. So for limited liability companies that are considered to be small companies, I will just highlight a few changes for businesses within this bracket. So I think they are the ones that we enjoyed the most under the new tax regime. So there has been a redefinition of what constitutes a small company. So under the new law, any company that has a gross annual turnover of 50 million naira or less, and the company has a total fixed asset not exceeding 250 million naira, is considered to be a small company. So I will reiterate that. So a company is considered, when I say company in this case, I mean a limited liability company. It's not an enterprise. It's not a sole proprietor. The company is registered as a limited liability company, and the gross turnover, your gross revenue in a year, is not more than 50 million naira, and your total fixed asset is not more than 250 million. So you are considered to be a small company. Insofar, that entity is not involved in professional services. It's not like a law firm or an accounting firm, as the case may be. So for law firms, they are not for professional services generally, they are not considered to be small firms or small companies, as the case may be. So what are the benefits that small companies tend to enjoy? So if you are considered to be a small company, you are exempted from payment of corporate taxes. Company's income tax is like you are liable to paying taxes at 0%. So no payment of taxes for small companies. No payment of capital gains tax. And also the newly introduced development levy is not applicable to small companies. And the development levy tries to consolidate a number of all of the other levies that companies currently pay, like the tertiary education tax, the NASENI levy, the Petroleum Trust Fund levy, and the IT levy. So that is consolidated now into the development levy. But for a small company, you don't have to be bothered about all of those burdens. So you are not paying corporate taxes, you are not paying CGT, you are not paying development levy, you are fully exempt from tax. So for large companies, yes, the rate currently is 30%. And the president is at liberty to revise that downward to 25% sometimes in the future if he deems fit. And the minimum tax rule has now been eliminated. I did mention that previously, that for companies that are making losses, so you don't have to pay any minimum tax. So that has now been totally removed from our tax law. I've also spoken to the removal of the subjective rule on expense deductibility. So if you're a small company or even any company at all, you only need to demonstrate that your expense, your business expense, has been incurred wholly and exclusively for the purpose of generating profit. So the requirement for you to demonstrate reasonability and necessity is no longer expected. So gifts are now fully exempt from tax. So assets that are acquired or disposed of without consideration are considered to be gift, and they are not chargeable gains. They are not considered to be chargeable gains. So with respect to value-added tax, especially for businesses, we now have the opportunity to make claims of input VAT recoverability on all purchases, including services, as well as fixed assets. So that is a good one for businesses. So because at the moment, businesses are not able to make claims of input VAT on fixed assets, and for those businesses that are involved in service delivery, they are not able to make claims of input VAT on their services. Now you can make full claims of all purchases, whether it's services related or it's a fixed asset. You can make a claim for that. And also, certain essential goods and services have been designated as zero rated, and that is very important for businesses generally. A number of these goods and services are currently deemed to be exempt from VAT, such that when they incur input VAT, they are not able to pass it on to their customers. But now that it is zero rated, all input VAT that you are not able to pass over to your consumers or your customers, you can make a claim of refund from the tax authority. So you can make tax refund on VAT that you are not able to pass on to your customers. So that is something that is really a very important one, especially for businesses that are trying to manage their liquidity, as the case may be. There are a number of incentives that we have under the new law, especially for businesses, that they can take advantage of. So I'm just going to speak to a few of them. The most important one is what I've mentioned for small businesses, that they are now fully exempt from tax insofar you you are still within the threshold of consideration to be a small company. You are not paying corporate taxes, you are not paying capital gains tax, you are not burdened with payment of development levy, as the case may be. So income generated by companies engaged in agricultural businesses and manufacturing of animal feeds are now exempt from tax for the first 5 years from commencement of business. So for those who are engaged in agricultural business, the first 5 years of your business, you are exempt from payment of taxes. So we have the introduction of the economic development incentive. So that replaces what businesses or companies currently enjoy as a pioneer status. So the pioneer status incentive has now been readjusted. So we now have economic development levy that is targeted at stimulating capital investment in defined priority sectors. For instance, people who are involved in manufacturing of renewable energy equipment, so they can take advantage of this particular incentive in order to reduce their tax liability. So deduction for research and development, companies that are involved in research and development, so they can make a claim of as much as 5% of their turnover. They can make full deductibility of as much as 5% of their turnover. Currently, they can claim about 10% of their total profit under the Companies Income Tax Act. But you can see, making a claim of 10% of profits, which is a smaller base, as compared to 5% of turnover, which is a larger base, speaks volume. So it's a good one for businesses which they can take advantage of. So these are just a few of the incentives that I've put here, or I have decided to speak to, so that small companies and even large companies can take advantage of the opportunities. For tax administration, a number of changes and things that companies and whether small companies or large companies can also take into cognizance. The very first is there is an introduction of a rule that if a company intends to perhaps engage in transactions or agreements that will give rise to a tax advantage or to a benefit claim, you are now required to report that to the relevant tax authority. In this case, maybe to the NRS. So if you want to engage in a particular transaction or some tax incentive process, then you need to report that to the NRS, as the case may be. And if you want to enter into transactions that you are not so clear about the tax implication of that transaction, then you are at liberty to request for private ruling from the NRS, as the case may be. So that's now documented in our tax law. So you can you can request for advance ruling on the tax implication of your transactions. So one very important introduction under the Administration Act is the fact that relevant tax authorities are now required to respond to taxpayers within 90 days from when an objection is raised by the taxpayer. If the tax authority does not respond within 90 days, then the position of the taxpayer is not considered to be final and conclusive. Under the current regime, the tax authority does not have that leverage. So they will issue assessments and they expect you to respond within 30 days. If you don't respond within 30 days, then the taxpayer is required or the assessment issued against the taxpayer is deemed to be final and conclusive. So now it's a two-way thing. So if the tax authority issues an assessment and the taxpayer responds to that assessment and the tax authority does not respond to the taxpayer within 90 days, then the position of the taxpayer is deemed to be final and conclusive. Taxpayers or tax authorities now have an opportunity to exchange taxpayer data amongst the different taxing authorities. So information from maybe, for instance, Lagos State Internal Revenue Service, if they have information about a company that will impact tax payments to another state authority, they might pass on such information to the relevant, to the other state authorities. So there is going to be enhanced collaboration amongst the different taxing authorities in the country. So quickly, I will speak to a few of the penalties and offenses that taxpayers need to be aware of. So failure to register for taxes, that will trigger a penalty of 50,000 naira in the first month in which the failure occurs, and 25,000 naira for each subsequent month that the failure persists. A company, a statutory body or company who awards a contract to an unregistered person, if you deal with an unregistered person, you are liable to pay an administrative penalty of 5 million naira. So the intent of this particular provision is to ensure that everybody registers for tax purpose if you are involved in their doing business. So companies are no longer required, or they are no longer allowed to do businesses with individuals or even companies or entities that are not registered for tax purpose. So if companies persist to do that, then you might be charged this administrative penalty of 5 million. And the last of the penalties I'm just going to highlight will be failure to file returns. If you fail to file your returns, then 100,000 naira in the first month in which the failure occurs, and 50,000 for each subsequent month in which the failure continues. So moving on, so what should we be doing at this point in time? We know we are close to the implementation phase of this new law. So it is important for us as taxpayers, whether it's corporate taxpayer or individual taxpayer, if you have side businesses that you are running, enterprises, sole proprietor, so you need to take the time to gain some holistic understanding of the implications and the ramifications of this new tax law. You might need to do impact assessment. How does this new law impact your business? The impact can be two ways. So if you're a large company, the impact can be adverse, depending on maybe you have to pay relatively more in taxes, and you'll be able to take advantage of opportunities that are there in the tax law in order to reduce your tax payment. And generally for everybody, there are opportunities for tax optimization. So you might need to better place yourself in a position that you'll be able to take advantage of the opportunities that are there in the new tax law. So you also need to enhance the capacity of maybe your tax officers or your employees that will be responsible for managing maybe your finance portfolio or tax portfolio, as the case may be. So all in all, this just summarizes what I have for us today, just to discuss the impact on businesses and individuals. I guess if there are any questions or clarifications, you can always reach out to me. I will take the time to support you on that. I want to thank you once again for the opportunity to speak to you. Thank you so much. Jazakumullah khairan. Assalamu alaikum wa rahmatullahi wa barakatuh.